Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. Nothing here is a solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. Welcome to the Special Situations cast. We have a very special guest today, Michael Wilkerson. He's been a student at Yale, got his MBA at Harvard, worked as an MD at Lazard and Citigroup, and he's now the CEO of Fairfax Africa. Michael, welcome.
Thank you very much, Bram. It's great to be here with you and with your audience.
Yeah, no, thanks for making it. How are you?
Doing well, yeah, thank you. Heading into trying to race towards the end of the year, like a lot of us. We're experiencing the second wave, deuxième vague, of the pandemic, and going through renewed potential lockdowns and confinement. But family is healthy and well, and we're making progress.
Well, good to hear. It's sad to go into the holidays like this, but I guess we're doing relatively well. Yeah, I'm so curious. So you have a great career, and you ended up at I don't know. You're currently at a subsidiary of like a value investing
Yes.
legendary company, and it's Fairfax Holding. How did you end up there, or how did you get there? That's how I should phrase it.
Yeah, I should back up. As you pointed out, I was for over a decade a managing director at Lazard, working primarily on large cap cross-border merger and acquisition transactions as an advisor. Was global co-head of the consumer food and retail group. In 2007, began a transition over to working on financial institutions. At the time, Lazard was very focused as a leading independent advisor and being able to advise some of the largest financial institutions around the world in and through the financial crisis. We did not have a credit crisis ourselves. We were a pure advisory model, and were able to step in and play a role. And I was fortunate enough to benefit from that and learn a lot from it. It's a kind of experience in life where I learned so much, but hope to never have to go through it again. As it was a very difficult and dark time for all of us, as I'm sure you remember. During that same time, around 2006, I began to focus in another part of my life on Africa. So I became on the board, became chairman of what is today one of the world's largest water nonprofits, an organization called Charity Water. Today, by this point, we have completed over 11,000 projects in some 27, 28 countries, impacted the lives of millions of people by providing safe access to clean drinking water. And
so I'm just really curious, what does it look like in practice?
In practice, the model for Charity Water is to raise awareness of the world water crisis, raise funding, and then to, through a very disciplined and diligent process of capital allocation, identify local operating partners in these countries in Africa to actually implement water solutions, sometimes on our own or sometimes in partnership with governments or otherwise. But our model always was asset light, in a sense that we weren't trying to build a big organization ourselves in Africa, but rather, as mentioned, identify high quality partners, hydrologists, engineers, people who are doing the engineering of developing water projects in these countries. We have been mostly focused on rural solutions, where we thought our impact would be the best. So the tagline for Charity Water has been, over these 13, 14 years, water changes everything. And the idea there was that the impacts of in rural Africa in particular, especially on women and girls, was transformational. When all of a sudden you freed up women and children from having to fetch water multiple hours a day, often from unclean and unsafe sources to begin with, that perpetuated cycles of disease, poverty, and illness. So
that's really breaking like the prototypical like hour-long walks of.
Correct, exactly. And I mention that because that was my beginning of a journey to Africa, of thinking about, in fact, while we were and are a not-for-profit, it was about how do you efficiently deploy capital in very difficult market environments? How do you find the right people to work with? Around 2012, 2013, I began to look at another potential opportunity, which was to do private investing in PE-style private investing in Africa. There was a particular situation in South Africa where my partners and I had an opportunity to take private a listed company in South Africa. It was a very interesting opportunity. We had one problem, which is we didn't have our own fund, hadn't raised any money, and so but the opportunity was so interesting and so compelling because it was a company that was a leading agricultural firm in South Africa and on the continent, whose vision was to drive food security across Africa. One of the things that I learned from my experience in water was just how critical food and water security is to the future of the continent, but not just about that. It becomes about global geosecurity as well. In history, we know that food crises, famines, and other things are big factors that lead to war and instability. And so we saw an opportunity here to actually make a difference, both at the local level for Africans, but also be part of something bigger. Having said that, we then went on a process to raise capital in a traditional private equity style, a GPLP type structure, and to a long way around to come back to your question, how and why Fairfax Africa. Around that time, we were introduced to Fairfax Financial, founded by Prem Watsa in 1984, 1985, value investor. He's been called the Warren Buffett of Canada, and has spent now well over 30 years in an investing model, building up one of the largest insurance companies in the world. But an investor at heart, and a value investor at heart. And Prem Watsa and his team at Fairfax saw some of the same things that we saw: the demographic opportunity in Africa, the potential to really make a difference. And it was something that was near and dear to Prem Watsa's heart, which is that he had seen the benefit of investing in emerging markets. He'd been investing in India and other parts of Southeast Asia for nearly 25, 30 years, had not done anything up to that point in sub-Saharan Africa, but recognized some of the same things in terms of the power of investment, the power of capitalism, really, when it's done well and fairly and properly, to change lives. And so you get the double benefit of returns for shareholders and actually making a difference. So behind that, that evolved from what, as I mentioned, what was a private equity type structure into 2017, taking Fairfax Africa public on the Toronto Stock Exchange, following in the steps of our big sister company, a company called Fairfax India, which 2 years before had gone public. And a similar idea: focus on a particular geography, in that case India, in our case Africa, have the benefits of a private equity-like structure, which is being able to take control positions where you can shape outcomes, shape the direction of companies, but yet in a public company structure. As you know, many of the private equity firms in the US and in Europe have at some point in their evolution gone towards a public listing. We came at it with the idea of having a public listed company, permanent capital, the ability to do anything that a company could do, meaning issue more equity, do share repurchases, buybacks, have the flexibility of corporate structure. But also, one of the challenges with the private equity model is that you are on a ticking clock. You do have a set timeline, and in emerging markets in particular, that's hard to do. You need to be able to give yourself a longer runway of investment. And while we absolutely want to be able to create
kind of
value
like
for shareholders,
a vicious disruption or something that's
yeah,
like at the wrong time.
That's right. So you have to be able to invest through cycles. And one of the things we've seen in 2020 has proven to be an example of this is from an economic perspective, the pandemic, or perhaps better said, the lockdowns and the confinement, the shutdown of economic activity, really hit emerging markets, and in particular Africa, disproportionately. So if you look at, all markets were hit in March. If you looked across equity, across debt, FX. However, Africa was hit much, much worse. You saw across markets. Now, South Africa went through a downgrade at the same time, but you saw equity markets down 40%. You saw currencies blowing out across almost every country in Africa, sovereign yields blowing out. It has been a challenging time. Much of the rest of the world has seen a recovery from that as we've gone into the third quarter, and we've seen advancement, economies opening back up, progress towards a vaccine. Africa was, and I talked about this at the beginning, was less impacted by COVID-19 in terms of the health impact. A number of reasons for that. A lot of the economies took very draconian and sharp measures to deal with it at the time. One could argue, I think the question is always valid, that we have to ask, is the cure worse than the disease? In some situations, and South Africa is a good example, where you see, they did a very drastic shutdown of the economy, deemed certain things to be not essential. So energy development was one of them. And one has to ask whether over the long run, whether energy insecurity isn't a greater risk for South Africa and Africa generally than was the more near-term impact of COVID-19. But that's a topic for another day. My point was that really we saw very sharp impact to all the financial markets across Africa. We have not yet seen a full recovery in Africa, even though some of the other markets, including some emerging markets, are beginning to perform.
Sure, cool. Thanks. It's very well explained. One thing I wanted to ask you about right away at the beginning is that I understand that you're transitioning into a role as executive chairman.
Yes.
Because you've made what I think is a transformative deal with a company called Helios. Would you briefly talk about the background of that deal or that transition?
Absolutely. So I mentioned Fairfax Africa went public in 2017, and almost right away we recognized that we had a really great opportunity in Africa. We raised capital, we had a presence and some expertise in South Africa, and had made, as I mentioned, a number of investments. We began to think about what else could we be doing to create something even better. And one of the thoughts we had at the time was finding a complementary partner, a private equity-like partner that had long experience in Africa, broader geographic exposure than what we did in terms of expertise. And we had had a number of conversations over the last couple of years. We had known of the folks at Helios Investment Partners. And just for background, this is one of the largest and most experienced African private equity firms in the world. They've been around since we invested together since 2003, 2004, founded by Topwe Lawani and Babatunde Soyoye. These gentlemen are Nigerian, US educated, trained, worked for TPG for a number of years, founded Helios, really around early adopters of a vision that private equity was going to work in Africa over the long run, and have been quite successful. So we saw in the Helios team a couple of things that were very complementary. One is that depth of experience, since, as I mentioned, let's call it almost 2 decades now of investing experience in Africa, led by Africans with on-the-ground experience and a very strong team in geographies around the world. I had known some of the senior members of the team for quite some time, going all the way back to business school over 20 plus years ago. And so from a standpoint that we believed that the partnership was the best of both worlds. Public company, then combined with private equity model, deep on the ground experience. From a public company standpoint, it also gave us the benefit of an asset manager with recurring fee income, where a lot of the companies that we intended to invest in were growth companies where capital was going to need to stay in the businesses. And we wanted to be able to start to work towards a dividend model where we could actually return cash dividends to our shareholders over the long run. So felt like a really great opportunity to combine forces. Both teams are coming together in this new model. So quite excited. We hope to be able to close this here in the next couple of weeks. We're just waiting on our shareholders meeting first week of December, and then we should be off to the races.
Cool. And so then you'll go from like a holding company, you look more like a KKR, so the KKR of Africa.
We will strive towards it over the long run. KKR is obviously much bigger and longer life than we are. We've been around for 3 years as a public company, but it would be a wonderful thing to aspire to, as you said, the KKR.
Yeah, I just meant like a mix of balance sheet investments and funds as well.
And that's the opportunity here, is that we will have the flexibility to do traditional fund investment through the private equity arm, or on balance sheet investing in situations where perhaps the PE model isn't right. It could be very long-lived investments, very short-lived investments that need to be in and out rather quickly, or for other reasons where having the balance sheet is beneficial. And as mentioned in emerging markets, and in particular in Africa, being able to be in for the long run through economic cycles and greater cyclicality is quite important to us.
Yeah. And it gets me to why I actually invited you on. Is you wrote a book. Actually, you banged it out in a few months. It's really impressive.
1 month, start to finish. I banged it out in 1 month. Yes, in September.
It's called Stormwall: Observations on America and Peril. I'm sorry if I mispronounce Peril.
No problem. We
From
say
reading your
Peril,
book,
but Peril. It's
oh,
we know what you're
Peril.
saying for sure. Yeah.
Yeah,
Thank
I'm
you.
not a native speaker, so it's a
Your
word that
English is
gives me a
much
little
better
bit of
than my
trouble.
Dutch. I'm sure. So.
And it's clear that you're worried about America, and well, I think that's not unusual. But please explain why you're worried and why you're
Yep.
worried now.
The idea behind Stormwall was that we were experiencing a very unusual set of circumstances in our country at this time. That there were actually 4 separate crises: the economy, the pandemic, a rising external threat in the form of China and the great power conflict, and then internal strife like we haven't seen here in a long time. Each of them significant in themselves, but the core idea of the book is that these 4 items, these 4 crises, 4 forces were actually interacting with each other in a way that was similar to what wave physics calls constructive interference. So imagine that you have 4 separate waves and they're coming together, and all of a sudden they're joining forces. Amplitude is increasing and creating a tsunami-like effect. And the argument of the book was that that was essentially what was happening while we were having a lot of conversation and hand-wringing around each of these separate issues in our media, in our dialogue, that not a lot of attention was being played to the nexus between them and how these things could be actually working against or with each other to make the crisis worse. And then that the other main idea was that the November elections and uncertainty around them actually created a very dangerous moment where the risk of seeing some sort of combination effect was quite elevated. And that linked, of course, specifically both to the internal strife and that we have at the moment a very divided country along political and cultural lines, and how that in itself was feeding into the external crisis. One of the things we know, and there's been a lot of talk on this, is that, and really throughout history, whenever there is internal strife, division, conflict, external forces, external enemies do take advantage of that. We saw it in the Cold War with the Soviet Union's interventions in the civil rights movement. And it's done on both the extreme right and on the extreme left, because their main point is not a particular ideology or argument, but rather to create division, sow division, and to amplify those divisions. And so they're not particularly concerned about whether they're supporting the right.
Actually, didn't know that. So we've already seen that pattern in like the 70s with civil rights movement and
50s, 60s, where the Soviets were very active in the U.S. on our soil, and with planting agents in cell groups of political movements on the extremes on both sides, agents provocateurs, so to speak, who were making things worse. And one of the things I pointed out was, by right now we're being forced by virtue of or lack of virtue, the pandemic itself and those internal issues, domestic issues, to think about those things that, were we not potentially taking our eyes off the ball, so to speak, of the external threat of the risks that were being posed by some of these challenges. And so I raised some provocative questions. But the first one, the economy, maybe we would start there if
yeah, sure.
Okay.
I think you've summarized clearly that you divide like it in 4 threads, right? And maybe you can repeat it one time, and it's the internal strife, external strife, economy.
First, the economy, the pandemic, the external threat, the great power conflict that we're seeing with China and her allies and the U.S., and that has been amplified in the last 4 years of the Trump administration, and then finally internal strife. On the first one, the main point I wanted to make about the economy was, if you look back at 2019, the U.S. economy was actually doing very, very well. We had one of the longest economic expansions on record following the global financial crisis. So specifically, over that decade, we've seen GDP grow at an average of 4% for nearly 10 years. We've seen 6% in private investment per year over that 10 years. In other words, in R&D, businesses were investing in R&D and capital equipment 6% a year, compared with the 2000s when it was basically a zero. and 5 out of 10 years were negative investment, where companies were investing less. So we saw real economic productivity gains. We saw real investment from private companies. And in fact, in 2019 was one of the best economic years that we'd had in a long time. We had median household income up by 7%. We had the poverty rate decrease to 10.5%, and the unemployment rate go to a post-war low of 3.5. It was benefiting all races and ethnic groups, and in fact, the non-whites were benefiting disproportionately. So Asians, Blacks, Hispanics, and women all were benefiting much more greater than than whites or otherwise. So it was a good broad recovery.
Yeah, you weren't in the camp of 2019. This is getting long in the tooth. This is kind of a little bit of a bubble.
Well, I'm speaking now about the real economy. Okay, now there's a difference between what was happening in the real economy, and we can talk about the financial markets. But sure. These was what was going on in Main Street. This is what was going on in our businesses around the world. Now, the point I made in the book was that all of this, we know, came to a screeching halt in 2012. People talk about, well, the pandemic caused the economic fallout. Well, really, what we mean when we say that is that the lockdowns, the shutdown of our economy and economies around the world is what caused the economic fallout. We'll never know what, if we had let the economy stay open, what it would have looked like, both from a health impact and an economic impact. Counterfactuals are usually not very helpful, but what we do know is that we did, for the first time that I'm aware of in history, willingly and cooperatively with governments and corporations and individuals, take actions that will have the effect of damaging our economies around the world. It's obviously true in the EU as well. And what that exposed in the US was that while I have just spent some time talking about how well the private sector of our economy was doing, which I very much believe in, at the same time, the public sector, the government sector of our economy over that decade has been facing very significant challenges. One, rising deficits. So we'd seen as a result of the global financial crisis, deficits had increased every year. The national debt, deflationary pressures coming out of it, and now having to deal with the pandemic itself. And the main point I've made in the book is that while there was some, perhaps remote, but still some hope that the government will be able to get back to a more stable fiscal situation and balanced budget and otherwise, while the economy was still ticking along, in 2020, as a result of these issues, government had to reverse course, started to deficit fund with a vengeance. I mean, if you look over the past decade, or almost 20 years now, the last time that we had run a balanced budget, a positive account was in 2000, 2001. So we've been running deficits that have averaged over $800 billion a year for 2 decades. In 2020, the deficit will have ballooned by over $3 trillion, okay? The national debt, which stood at $5.7 trillion in 2000, will be, I believe the numbers are $26.5 trillion by the end of this year, approaching 100% of GDP. These numbers are extraordinary.
Yeah, if you pull up the graphs, it's all very visible.
Yeah. So we in some ways have a tale of two cities, two worlds. One, the private sector economy doing very, very well through the decade, and government having these fundamental issues that were able to be postponed while the economy was doing as well as it did. Now having to make some difficult decisions that unfortunately will set us back in terms of our progress. The link I make there is that for the first time in our generation, our lifetime, I believe that there is a real risk of emerging inflation. And we don't even know how to talk about it because we've been in a deflationary environment for so long. But if you look at the history of inflations in Europe, you've seen them, there's a greater understanding, history of inflations and understanding their impact in Europe than there is in the US. You recognize that deflations can quickly
You talk about it in the book, it's because of the Weimar history, right?
The Weimar is the biggest and most notable example. But if you look at all of the European economies following the Great War, every economy went through inflation. The UK, France, Netherlands, every economy that was involved in one way or another in the war went through significant inflation. The Weimar Republic, there's a lot of history there. It's beyond the scope of what we can probably cover today, is the most notable example because it was horrific. The Weimar Republic and the emerging Russia, the revolutionary Russia, Bolshevik Russia, basically saw their currencies go to nil. That it was just absolutely worthless, and this was devastating to those economies. But anywhere else in Europe also saw multiple years of double-digit inflation, decrease of purchasing power. Pensioners and anyone on a fixed income suffered enormously as a result. And I made the point that regardless, you can look at this as let's take a world in which we didn't know, and perhaps we don't, who the next president is going to be. In a Biden-led Democrat administration, we have a set of risks that are all inflationary, and I would argue in a Trump-led second term, we had inflationary pressures that are hidden. And what are those? So the argument would be that on the Democrat side, so in a Biden-led administration, that it will be impossible or extremely difficult for President-elect Biden to restrain the forces of the more radical left in terms of its economic policies. So there'll be great pressure to use fiscal policy to spend. There's a lot of talk now about canceling student debt, which totals around $1.5 trillion in the U.S. today. A number of other policies that almost by definition.
Modern monetary theory is getting a lot of traction.
Some of the advisors to some of the Democratic candidates, including Bernie Sanders, were the main advocates of modern monetary theory, which is extremely dangerous in my view, because it basically says that as the monopoly issuer of currency, governments can print as much money as they want, and while they would admit that yes, inflation is a risk, they argue that they can control it by taxing it away. Mm-hmm. I don't agree with the first argument either, but I think the second is extremely dangerous because history has shown that once inflation is out of its cage, it is very, very difficult for governments to put it back in. As a practical matter, the government's ability to continue to tax away inflation runs out, and then they are left with one policy option, and that is the printing press, and that is to print more money.
And otherwise you're almost always forced to engage in very unpopular measures, right? That won't get you reelected or stay in.
Right. You have to take very draconian measures, as we saw in the U.S. when we had a period of stagflation in the late 70s and early 2000s. And it was a very painful process to cut inflation, because it does.
The U.S. saw like 12-14% inflation on an annualized basis, maybe?
That's right. We had a couple periods, one in the early 70s around 73, 74, and then again in 79, 80, where we got sort of high double digits on a monthly or quarterly basis. It was almost 20%, and then but annually, yes. And it was very painful to reverse the process.
Yeah, absolutely. But would you agree that, well, I'm not sure, maybe 3% inflation would actually be pretty nice. It'd solve a lot of, or smooth over a lot of issues that are.
There's no doubt. The question is, can you control it to that level?
Sure.
Can you, and this is the point, could we benefit from some inflation? Absolutely. Mm-hmm. I think, Japan has struggled now for, nearly 3 decades to try to get some inflation in their economy. The consequences of deflation are as evil and as bad on the economy as is severe or hyperinflation. So there is a magic range, a magic number. My point is not so much that as to whether governments, once those pressures build and once markets start to believe that inflation is coming, how do you control it? How do you keep it at that magic number before those pressures get offhand? And so the argument on the Democrat side was pretty clear. On a second Trump term, it was less obvious, but to me it's there as well. And it happens in the following way: that if Trump were reelected, that he would then have the mandate to pursue the policy of decoupling from China, which was announced, I believe, in August of this year, where basically, he said that it would be U.S. policy and would encourage the private sector to decouple the trade relationships, the supply chain relationships with China. Now, you say, well, why is that inflationary? Well, we have to make one assumption, which is that those supply chains exist today because there's a view that that would not view that they are the most cost efficient, that they've been established over time because companies have found a way to get very efficient delivery logistically in terms of just in time and otherwise from China at what is the lowest world price. If you cut
that's
that
almost no doubt that they were more efficient than they were before. Like it's a whole globalization process.
Correct.
Yeah, and now we reverse that, and it would be a little bit
If you cut
inflationary.
it, that's right. If you cut it off, and whether you do it by import substitution, in other words, the U.S. is able to rebuild domestic manufacturing capacity, or you do it by finding other supply lines, maybe more proximate in North America or otherwise, the prices will rise.
And maybe if I can, I'm sorry to interrupt you,
please.
but maybe one counter argument sometimes heard is that if the US would onshore, that a lot would be robotized. You think that will be too slow, or?
I think it may be applicable in certain areas, but this is the sort of the cost of capital versus cost of labor question. In certain industries or certain timeframes, yes, but there are a number. If you think about all of the thousands of product categories, both industrial and consumer products that are now sourced from China, it's very hard to see how recreating those capabilities in the U.S. it can be done in anything other than higher prices, inflationary cycle. And there may be other policy objectives that serve to justify it, but my point is purely from an economic perspective and the question of prices and inflation. These are the effects that it would have. And then, of course, that is the job of governments to make that trade-off and to think about within their industrial policy at what cost and who benefits.
Yeah, and so I would really like to explore this more in depth with you, but
Sure.
You wrote a real expansive book, and I think it's unique in that it ties a lot of things together.
Yeah.
But so the main economic threat, inflation, is that?
I think the main economic threat is that our government is in a much more fragile position than is our private sector economy. That inflation is a threat for the reasons that I've described. And I suppose a third reason that we should just talk about is to the extent that the rest of the world begins to lose either confidence in the US dollar or the economy or views the returns on the US dollar to be less attractive, since today they're negative in real terms. That may shift our ability to continue to deficit spend.
I think that's like the only threat that can stop the Fed from what it's doing. It will work unless people start losing their confidence.
Right. And so one of the things that I mentioned in the book was you are hearing a number of voices now who've thought about these issues for a long time. Folks like Stephen Roach, Ray Dalio, basically saying that the threat of a devaluation is pretty significant. It's pretty high right now. That if it happens, it could be substantial. I think Professor Roach talked about 30-35%, and by the way, that would not be uncommon if you look over the long arc of history. You see every decade or so these kind of currency devaluations, and of course Ray Dalio has been talking about this for quite some time, the long arc of the 50-year debt cycle.
Wow, that's if it happens quickly, it's a real scary prospect. Let's see, and then maybe we should.
And just on that point, I think you commented at the very beginning. Gosh, you wrote this fast, and I did. I wrote it in a month. And one of the reasons that I did was that it began to occur to me in the last few months preceding that we were at a very difficult time. History moves very, very slowly until it doesn't. Until suddenly it arrives, and a lot of times these changes do happen very quickly. And I wrote it so quickly because there was a sense of urgency that these are real-time issues, that, as I mentioned, that the November elections were creating increased uncertainty around any of them or a combination of them catalyzing into a very dangerous moment for the US and for the world. And one can think about, there are obviously other long-term issues and risks that we do need to be focused on. Climate change is clearly one of them. But what struck me about the topics that I raised was just that sense of urgency, that we are in a moment where something could change dramatically and quickly that catches us all by surprise. And the point of the book was not to invoke fear at all, but rather to raise that awareness and to say, take courage and think about if these are risks, what do we need to be doing to prepare as governments, as corporate leaders, and as individuals, as heads of households.
Yeah, that's something I really want to get into with you. Maybe let's move on to the pandemic, and we'll finish your 4 main points, and then hopefully we'll have some time to discuss what we can do to mitigate some of the risk. Okay, the pandemic, your view is that lockdowns may have been a little bit too much?
I think my view is that, and first of all, I think it goes without saying that I'm a business person, a leader. I'm not a scientist. I'm not an epidemiologist. So sure. I tread cautiously. But what I observe is that, as a general leader, so whether it be a head of a company or corporation or a head of state, that what that kind of leader has to do is be able to incorporate information from all of the experts to think about the impact of health, the impact on the economy, the impact on mental health and well-being, incorporate all of those factors. And in that more balanced sort of generalist leadership view, I think that there's a real question about whether the severity of the lockdowns, and we're in the middle of a second phase of this, of going, most countries in the Northern Hemisphere are now going back into a period of lockdowns and shutting down the economies. We're seeing greater resistance or questioning, let's say, from both citizens and corporate leaders about the efficacy of it and whether is it really worth the cost. And the main question that I wanted to put forward, or at least suggest, is, in my view, we may be not counting enough of the cost. We've seen a couple things. One, we've had now the experience of, 6 or 9 months of what the lockdowns, what the consequences are on the economy. And secondly, we have much more data now about the morbidity and mortality of SARS-CoV-2. And what we know is that COVID-19 is clearly dangerous, especially for the elderly. Conversely, if you look at the impact on, it's been measured differently in different countries in the US or UK or Europe, but let's call it under 55 or 60, otherwise healthy. It is a problem, but not a typically fatal problem. Only 1% of total deaths in the US and in the UK have been from under 55 and otherwise no pre-existing conditions. So the question is, are lockdowns that are primarily impacting working age people, is that the right response, as opposed to recognizing that it's the elderly and those with pre-existing conditions who are most at risk, and finding a more targeted and strategic way to deal with that issue? So we know what we now know about the working age population, but the other thing that we've learned, and our own in the US CDC just came out and said, keeping children away from schools is not the answer, that the schools are the safest environment for them to be. And yet in certain states and certain parts of our country, we are making the choice to pull kids back out of schools. And it's terrible on the kids. It's terrible on their families, and it hurts the poor more than it hurts the wealthy. If there are certain folks, creative class, people who can work off of Zoom calls like this, conduct their business. But for most people who have to show up somewhere and work, if you can't go to work, you can't find childcare, afford childcare for your kids, keeping kids out of school. These are real challenges, and so I do think that in some cases the attempted cure has been worse than the ill. Sure,
cool. I think you're probably right that in there's a lot of regional differences in how things were handled. Mm-hmm. I'm pretty satisfied with how it was done in the Netherlands, given that it's never happened before. It's a hard problem. Things will go wrong. But even I do not completely agree with you on your views on the pandemic. But it didn't matter that much to me enjoying your book, because it is part of your pillars, and it doesn't demand that I subscribe to exactly every view. to get to
Sure.
the whole picture of this a threat. And I mean, even the differences are maybe, it is not worth talking about.
And if every reader agrees with everything I said, I did not do my job. These were difficult and controversial subjects, and I think they're worthy of debate. And,
yeah, sure, yeah, and I absolutely think that you don't have to be an epidemiologist. I'm not going to try that again.
It's a tough one.
But to have an opinion, it's valuable that we know a lot more about companies and the economy than other people, and that's valuable too.
One of the main points that I made in the book is putting aside our views on these kinds of issues. What the pandemic revealed is how inadequately prepared the world, the US, Europe, it doesn't matter. It's kind of generally true. But my book was about the US. I focus on America, how unprepared we are for cataclysmic events, that whether it be, in this case, it was a biological threat. I talk a little bit about the controversy around whether it was completely natural or not, but that's probably one of the most controversial subjects that one can get into. That's not the point. The point is that it revealed, because we saw immediately supply chains being disrupted, hoarding of food, inability, grocery shelves were empty. And it reveals that if the risk of damage or attack on our critical infrastructure, our electrical grid was one of the things that I focused on, where I think we're particularly vulnerable. I'll give an illustration. The U.S. is a very aging grid. A lot of the main components, main elements are 30, 40 years old. And as part of the outsourcing of our manufacturing capacity, we've actually lost the ability to quickly rebuild and replace these multi-million-dollar transformers efficiently. So if something were to go wrong on our grid, whether it be an attack or a natural event, a solar flare, or whatever kind of natural occurrence could happen that impacted a portion of our grid, we may not have the ability to do anything about it for several months or potentially even years, because we'd be forced to look to China or look elsewhere to rebuild that infrastructure. And that's a very dangerous place to be.
No, and it's a great segue, because we need to move you to China, because we're running low on time. China is the main external threat that you identify, and which is, I think, under Trump administration has come under tremendous focus. Before it was not really in the picture. Maybe there was a lot going on behind the curtains, but wasn't as visible.
That's for sure. And I think whatever one thinks of Trump and his presidency, one thing that I think history will show is that he did pull the facade off of the Potemkin village of the US's relationship with China. And whether it should have been done in the way it was done, that's a whole other matter. But what I mean by that is, if you look at 30, 40 years across multiple administrations, Democrat and Republican, we had seen in the US a bunch of forces at play. There was clearly massive transfer of intellectual property, some of it legal and some of it illegal, through espionage and other means. We saw the evisceration of our manufacturing base. We saw a lot of things happening with China in that relationship that hadn't been addressed in a long time. And again, without regard to whether it was done in the best way possible, I think it was important to have a reset of that relationship, to have, in some ways, the kind of confrontation that hopefully leads to a greater balance in that relationship than existed. And so you're right, it hadn't been as focused on. I think people were aware of the issue, but it clearly became one of the top priorities of the Trump administration, the Commerce team, the Trade team, and Treasury, and was clearly part of their platform from the beginning. Will be a great question to see where that relationship goes now, but I think the steps that were taken probably were necessary for that reset.
Yeah, but it already influenced like Europe's relationship with China. I think it revealed sort of a tipping point. Maybe it coincided, maybe Trump pushed it there, where Democratic world said it's enough. And I think maybe the IP theft got a little bit out of hand, or maybe it started to be higher technologies, because I think that's been going on for 20 years or something.
Mm-hmm.
But when it was like
long time for sure.
Yeah, when it was like sort of like I know paint got copied or like a pump or something, but it wasn't so threatening. And then maybe it got into semiconductors, a different story. Or
yeah, I think I think there were critical and very sensitive parts of our economy where information was transferred, and so that's probably a problem over the long run strategically.
yeah,
Sure.
so that's and then let's get into internal strife because I want to get your views on what we can do to make things a little bit better. Internally, there's a lot going on in the United States. This was a big year.
Mm-hmm.
What stood out to you?
I think this year has revealed a number of underlying issues. So we've seen, and let me start with this, that today, and again, regardless of the outcome of this election, we're in a very dangerous situation where, regardless of outcome, 40%, 30 to 40% of our country will not believe that the outcome was legitimate. Okay, so if President-elect Biden is in the White House, you will continue to have, the hardcore Trump supporters believing that it was done fraudulently, that it was done illegally, that there was a massive conspiracy. If somehow it's overturned and Trump wins, you'll have a similar proportion of people on the Democrat side believing that there was something was wrong and this was a coup, this was a conspiracy. That's a very, very unstable situation for a democracy, and unfortunately, even as of today, I don't see a good way out of this dilemma. You combine it with what we've seen around Black Lives Matter and other issues where whatever one's view is of the organization itself, the movement reflected a significant portion of Americans who feel disenfranchised, who don't feel a part of this country, part of the process. Also not a good thing, very bad. And underlying all of that, and I talk about it in the book, is you do see over the post-war period in the last 50 years a rising tide of income inequality, a widening wealth gap. And what you see over the long arcs of history is that these things happen whenever we've had, in the modern world, we should say, an industrial technological revolution. So we're in the middle of one right now with with data, technology, internet, social media, all the things that are going on right there. But similarly, at the turn of the 19th to 20th century, you saw the same things happening with the Industrial Revolution. So with the oil companies, with railroads, with the building up of an industrial base, created then and now winners and losers. And in both cases, what we saw was that the returns on capital were much higher than the returns on labor, and that has over any period of time a disequalizing effect and rising inequality. So we're in the middle of that right now. But one of the things that you see over history, whether it be in the 1870s or middle of the 19th century in Europe, in the US in the 1930s, and I would argue now we're beginning to see it, is at some point that rising inequality boils over into social unrest. It's pro-extremist in that it gives people, whether it be, and we saw it again, let's go back to the 1920s and 30s in Europe and in the US. You saw the rise on the left of communist and socialist movements, and on the right of nationalist and fascist movements. We're seeing the same kind of grassroots kind of things happening here now, and in Europe, as you're aware. And the argument goes that the rising inequality, whatever its causes, the fact is that income inequality is rising, the wealth gap is increasing, and that those things tend, all else equal, to lead to divisiveness and to conflict and to the rise of extremism, and we should be aware and be very concerned. And I brought it to a conclusion of saying, because of that division in our country around politics and cultural and social issues right now, that the November-December period just feels extremely dangerous. We haven't seen, we saw some things in the 2 or 3 days following election day itself, but it's been relatively calm and quiet for the moment. Again, if there was some reversal of course here, I think we could see renewed unrest, protest, riots, etc. And it's a very dangerous time for our country.
Yeah, I used to be in the camp that a good recession or some inflation would cure a lot of the inequalities, but it's not happening, and it's getting pretty out of hand. So
Yeah.
fully subscribe to that view. Could you maybe, before I have to let you go, it's been super interesting, so I would love to keep you another hour. What can we do to make things better? And I would like to have your market view on how does it translate in, do I keep my stocks?
Yeah. So I think we didn't quite get around to, I mentioned there was a disconnect between now what's happening in the real economy and what's happening in the financial markets. Maybe we just touch on that briefly, which is to say that in spite of the downturn in the real economy this year, where all economies have faced significant impact, financial markets seem to not be acknowledging it. Weren't really impacted by the pandemic itself. Initially, yes, and then things started to take off again around May. And I mentioned in the book that I think there was a very interesting article in the Financial Times in May, and one of the writers, journalist Paul Murphy, wrote the Zimbabwification of Wall Street. And he was trying to explain this phenomenon. Why did we have this decline in the real economy, but the stock markets were still on a tear? And he used the analogy of what had happened in Zimbabwe in 2008, when the economy was in shambles, real economy was falling apart. They were having political unrest, government issues, and the beginning of inflation. But yet, the equity markets were miraculously just going up, 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 up. And he made the point that clearly what was happening was that Venezuelans, investors, and average folks were looking for inflation hedges. They were looking for a way to get out of their currency into hard and real assets. There is an argument, people will disagree, that what we see going on, in part, may be a similar process, that people are recognizing the inflation risk or the mind of the market, even if individuals aren't particularly conscious of it. You see it in the performance of hard asset classes like gold. It's up by 1/3 since March lows. Forestry and timber up by 2/3. S&P itself, of course, is up by over 50%. You've got the cyclically adjusted PE ratio now at over 30 times. Even in housing in the U.S., we've now seen over this last decade that cost of housing has risen at double the rate of income. So clearly an indication of another bubble. So I think that, and of course, we've seen a lot of volatility. So to answer your question, as an investor, I do think that it is a precarious moment. And I've mentioned elsewhere that I think for other than the true experts who are very experienced as traders and with the ability to manage risk, like they actually have an active risk management strategy. For the average investor, and we've seen this big rise of day traders and amateur traders in the pandemic, in the lockdowns, of people at home with platforms like Robinhood and otherwise. And for anyone who'd listen, my advice is now may be the time to not be in the markets. That while I'm certainly a believer in the markets and believer in the general principle of being invested over the long run, the short-term dangers, the short-term risks lead me to a different conclusion, at least through the end of the year. So, and
because you fear that more than the inflation risk, that maybe
the hedges I mentioned. So let's take equity, gold, obviously. Let's take equities and housing. They're good reflationary asset type investments. But there is some basic assumption that they're not already overvalued when you start. So if we're starting today from a point where all of that sort of reflation or all of that is already priced in, then it's less clear to me that it still makes sense. Now, a lot of what I'm saying assumes, and I mentioned, history arriving suddenly, that we're not just going to stumble into inflation. What's more likely to happen is one of the bad things, one of the parade of horribles that I laid out in this book. If something like that happens and we're going to see a sharp decline, we're going to see the kind of devaluation that Stephen Roche spoke of, and then might be a good entry point. But it feels like not the best entry point, even if one believes in the inflationary argument. Perhaps gold short term might be better because it's seen some of the air let out of it over the last few weeks, whereas equities and housing have continued to decline.
Okay, maybe if you have a mortgage or something which is not paid off, that helps a little bit with inflation. It's a default.
Definitely better to be a debtor than a creditor creditor in an inflationary environment.
Yes,
That's for sure,
another
as long as you can afford
recommendation.
So,
And then, yeah, because you painted a pretty bleak view. What do you think are important things that we do as a society, or maybe that
sure.
I can do, or you can do, or
Yeah.
that people are
And
doing?
I said this before, but the point of the book was not to paint a negative view in the sense of creating fear or panic at all. It's rather,
No, you
you know,
didn't.
nothing is more important than to be prepared, to be aware of what are the risks, like anything in life. You know, to know where your risks are is quite important, and then to take very practical steps to think about how can we address it. So we talked a little bit about the investment strategy. I realized as I was thinking about contemplating some of the big risks that even on a personal level as head of a household and parent and otherwise, you know, there's certain just basic things that I can be doing in my life. You know, I mentioned the risk to the grid. Well, what would you do if all of a sudden you didn't, you know, what we've come to rely on in terms of access to power and to data communications, if that were temporarily disrupted? By temporarily, I don't mean for an hour, but, you know, for a number of days or weeks. Tough questions to ask, but probably worthwhile to be thinking about in life.
Increasingly
Risk
practical.
mitigation. Yeah.
Yeah.
So I think, and by the way, these are challenging topics. They are risks. They're short-term risks. Over the long run, you know, I still very much believe in the prospect and the, you know, the opportunity of the U.S. and European economies to perform well. We just need to be aware that there's a little bit of some traps laid ahead of us that we just need to navigate.
Cool. Well, with that, I want to thank you so much for coming on and explaining your views. Where can people find your book or most easily buy it?
The easiest way to do this is stormwallbook.com. So you'll go there to stormwallbook.com. It'll direct you. You can go to either Amazon, where it's available in paperback, or digital Kindle. Apple Books is also accessible through there. It should be on both platforms available in most countries around the world. If it's not somewhere, send me a message, let me know. But stormwallbook.com, and really appreciate your support.
Cool. And then maybe it's a bit of a dumb question, but Stormwall, maybe I'm missing a cultural reference. What is the title? What did inspire the title?
A stormwall is it's a weather term. It's like, excuse me, the gathering storm cloud that builds and builds and builds, comes together, and then drops a precipitory load. And so, as the cover of the book invokes, I don't know if your audience can see it, but
cool.
You know, we've got storm clouds off in the horizon over the U.S. And so the idea is to evoke, you know, a storm, a challenging moment that could break suddenly on us.
Got it. Yeah, it's a weather difference. Well, thank you very much. With that, I'll let you go. And yeah, just
appreciate it.
Thank you so much.
And big fan of what you guys are doing. So thanks very much.
Thank you.